Hello and welcome to the FinTech Voices podcast. For today's episode, we're going to take a deep dive into the UK mortgage market. I'll be joined by Stephen Brown, Head of Mortgage Intermediaries at Scottish Building Society, and Nick Lawler, who's the Market Director for the EMEA region at Mambu. So welcome to the show, gents. Great to have you both here, and looking forward to just getting straight into the discussion. So before we kick things off, can we just maybe start with some introductions, just a little bit about who you are, what you're doing within the organisation and what you're focused on just now. So Nick, shall we kick things off with yourself?
Yeah, of course. Thanks for having me. So yeah, my role, as you said, Market Director for EMEA at Mambu, which sees me working with our existing customer base, new customers, as well as all the internal teams and partners we have externally, from SIs to tech partners. Been with the company 2.5 years, been in the core sector for about 8, but financial services for over 20, having worked for bank as well.
Nice. And yourself, Stephen, just a bit
Yep,
on
so
your
I'm
background?
head of intermediary distribution for the Scottish Building Society. So we're the last remaining mutual in Scotland. We're the oldest building society in the world, our claim to fame. So I hold the sales target for the business. I'm responsible for all new mortgage lending, but as with small businesses, my responsibilities drift into other areas. So I'm a mortgage subject matter expert. I'm focused just now on integrating our mortgage front end, our new platform, which is MSO from Iris. So we're working on that at the moment. My background, I've been in financial services for 20 years. I predate regulation. I know looking at me, you probably find that hard to believe, but my first authorization went to the Mortgage Code Compliance Board, which actually was before the FSA, never mind the FCA. So I suppose you could call me a mortgage dinosaur in that regard.
Or veteran, I think it could be.
Or veteran, very kind.
Yeah.
I was just thinking dinosaur myself there as well, Stephen. So it's a good mix to have yourself. And then Nick, I suppose we could see you as a bit of an innovator in the space, given your role. So keen to just really hear the thoughts on the two of you as we go through the discussion. So just a breakdown of that, just looking at the UK mortgage market as a starting point, and then some considerations of how that's affecting consumers, how that's affecting lenders. And then we can move forward from there, just to maybe look at what the future of the role of technology and data within that. So should we just kick things off right from the very start and just just lift the roof off the current state within the UK mortgage market? So what are the current conditions like, and how is the outlook just now? Do you want to start, Nick?
Yeah, I can kick off. Obviously, I'll have my view from a technology perspective, but as well as having a mortgage myself and having worked in the sector, and then as Stephen, the veteran, I'm sure he'll have some more vital insights. I think the mortgage outlook in the UK at the moment, things have calmed down. The interest rates were rising. They've held. They will start, I believe, to reduce over the next few months, 2 years, I think, to settle. But we've seen that market move, which is interesting. It's a shock for a lot of people. Everyone was used to historically low rates. They didn't know a rate above, your 5-year fix of 1.75s, maybe your 1.5s, that kind of thing. People were stuck on that, which meant from a disposable income perspective, they had lots of it, which meant you could buy your brand new cars, you could have a way of life that has changed. It has fundamentally changed for people who have come into new mortgage deals that have seen the rates double and they've seen their mortgage payments considerably increase. But I think that's settled and people are more accepting of it now, and it won't go back to where it was before. But it will take a longer time to kind of move on. I don't know if you want to jump in there, Stephen. I don't want to talk for too long.
No, that's good. I mean, I think if we look, so one of the key indicators that lenders use is SONIA swaps. So they're effectively a financial instrument that drives lenders' pricing. So, I don't think there are going to be any seismic reductions in the base rate over the next year. We're probably looking at sort of 50 basis points to 70 basis point reduction. The 3 to 5 year outlook, we're not going to see any radical reduction. Base rate longer term, maybe 3.5%, 4%, something like that. I think the frame of mind with the rate setters now will be driven by inflation. So if you look at some of the historical changes in the base rate, inflation wasn't really around or wasn't a factor at the back end of the credit crunch. The Bank of England were very quick to drive quantitative easing to drop the base rate to near 0%, and inflation really wasn't around then. or certainly wasn't it was around, but it wasn't a factor in their minds. You fast forward to the COVID pandemic, and again, the Bank of England rode into the rescue, and they probably weren't thinking too heavily about inflation at the point where they dropped the base rate down to, again, a historically very, very low level. I think we'd be unlikely to see such significant swings in the base rate moving forward. I think inflation is one of these things that's quite ethereal. It's a bit like toothpaste. When you take it out of the tube, it's very difficult to get back in. And I think we're probably likely to see more modest movement in the base rate, I would say certainly for the next decade. Even if we were to run into some kind of financial catastrophe, it's quite unlikely that the Bank of England would pull that lever just as enthusiastically as they have in the past. That's not to say that they wouldn't come to the rescue in some way. But yeah, I think we'll probably see more modest changes in the base rate over the years to come.
Thanks, Stephen. And what's the implications of that for lenders then? How are we seeing the market diversify and sort of how are we seeing lenders evolve to meet new market conditions?
So, I mean, you could look at the sort of product outlook at the moment. Is quite strong. So there are just over 5,000 mortgage products available in the UK just now. So in comparison to, say, around April in 2021, there were around 3,800. So that's quite good. It's quite positive. There's a lot of competition there. But I think we're still running into the same challenges that we have, year in, year out. And a lot of that is driven by operational capacity of the lender. Mm-hmm. So we see the hokey cokey, if you like, of lenders moving in and out of the market when they struggle to cope with operational demand. So I think the average, I read somewhere the other day there, the average shelf life of a mortgage product at the moment is about 15 days. Some lenders are in and out within 40 hours if they can't sustain that peak operational demand that's flowing in through their front door. So it does make it difficult for both customers and for mortgage brokers as well. There's a lot of chat just now about no notice withdrawals. So lenders are compelled to withdraw products very, very quickly with almost no notice at all. And that's giving consumers very little time to make their mind up. So they can be presented with an ESIS document, which is effectively an illustration, and they're perhaps been told by their mortgage broker, you may only have a few hours to make your mind up on this, which is it's arguably one of the most important decisions you'll ever make in your life, particularly around a house purchase. But you're really not getting time to make the decision because the product can be there and it can be gone very quickly. And I think this year is very different to last year. So we saw no notice withdrawals last year, and that was driven by the increased cost of funding last year as swap rates rose. This year, I firmly believe it's around operational capacity, and that's what's causing issues for lenders.
Interesting. And I guess you're leaning in there to the idea that mortgage brokers are competing a lot on product and on interest rates. But, is there enough consideration to the consumer and that consumer experience and what the borrowers really need? And we sort of touched upon this, earlier, when we were just chatting, and the experience I'd had as someone who had remortgaged and having shifted from being employed to becoming self-employed and then moving off a fixed rate onto a variable rate, which I became stuck on. An increase month on month until I could get a shift where it led me to an £800 increase monthly on what I was paying, and it was a hard one to take. But beyond that, it's the experience that went with that. The lack of transparency. It's certainly not a simple process. The lack of efficiency and having to continually update and resupply things like bank statements, all that sort of stuff. So what's happening in the background with lenders around that customer experience? What's being done to really shift the dial on that and to try to compete in that space alongside the product shift that you've talked about? So
you were a mortgage prisoner.
Yeah,
ultimately, you were a more. It's not a good thing, and it's a really bad thing in our industry. So we've seen a new piece of regulation come in from the FCA called Consumer Duty, which we've all, as lenders, been working very hard on over the last 12 months. We have a really focused Consumer Duty dashboard now, which would have called out you as an individual within our business as being someone who was paying more than they should have been. And the focus has definitely been put back firmly on lenders to look at I think you would probably have been on what we call SVR or standard variable rate. So the focus is very much now on us as a lender under Consumer Duty to monitor our SVR populace, to make sure we're fully aware of why our customers sit on SVR and to make sure that they get access to the correct product that they should be able to ultimately bring down their costs. So I think consumer duty will help with that. There's no doubt about it.
It's also, when you kind of think about it, this new world of rates isn't just for the consumer, it's for the lenders as well. You've got people who've worked in the building society or a bank or for a lender who have not seen a rate change. It was new to them. We know a lot of the, you think, that you get the comparison sites who capture the data. This was a new world for them. We haven't seen the rates move, so they've had to keep pace as well. So it's not just about you yourself as an individual. You found yourself as a mortgage prisoner, which, you felt the ultimate pain of the money coming out of your bank, but you had people within that bank, as you said, Stephen, you're pulling products in, could be 40 hours that they're trying to put a rate up and not get caught at the top and get too many applications. The staff are having to adapt to a system that may have not been fit for purpose now. It could have been in situ for 20 years and it was fine when rates moved as you expected, but to see the continual increase and have to build and launch new products quickly to market, that's a strain on, which I'm sure you, Stephen, at Scottish would have felt. There's a strain on you as a business. You're having to, get your staff to change the way they work, to launch products, pull products, monitor the markets, and a lot more detail than they've had to, which also is affecting the consumer because they don't know whether to go up, go down, hold. What do you do? Because you don't know what could happen tomorrow. Not just on the base rate, because the base rate doesn't move daily, but everything around it, the swaps, what are your competitors doing? That does move daily. And I think that has an impact on the business as well. So
you're right. You're spot on, Nick. And it has an impact on the financial advisors and the mortgage brokers. I had a conversation around 3 or 4 months ago with a broker who, great guy, but he completely misunderstood the concept of a discount mortgage and what it was. Because fundamentally, for a decade before, most of the advice had been flowing towards recommending either a 2, 3 or 5 year fixed rate. And there are subtle nuances between a discount and, in this instance, what the individual thought was a tracker, and the way that those products move. And I think now, more than ever before, getting good quality financial advice is so important. Because the discount may not necessarily fall in line with the Bank of England base rate, and you should never confuse those two products. And I think that's why now it's so important to get a good broker who understands the mechanics and the granularity within how those products actually work, and not just sitting down the kind of bog standard ESIS and assuming that that's the right thing for the customer.
Well, I think you're also going to see from the broker side of things. I mean, that's kind of the world I used to work for, NatWest Intermediary Solutions back in the day. And some of the people I work with, one of them set his own brokerage up that's been established for years, PSG Financial. I was speaking to him recently, and you can see in the market there was a big influx of mortgage brokers. We saw the boom, didn't we? We saw the reduction after 2007. A lot of brokers went away. Then in the last 3 years, the boom created again. We saw more mortgage brokers come back to market. And I think we're going to see a shrinkage in that space again, because if you have a strong, you'll know this obviously from the Scottish, a broker who's been doing it years with a strong back book and customer base, they'll notice the impact, they will slow, but they will be stable. But if you've had someone who's maybe set up a brokerage or not done it for long and they recently entered the space, they won't have, as you said, the skill sets and experience, maybe even the relationships with some of those providers to know, I'll pick the phone up to that person for help for the mortgage, for the timelines, which does have an impact. As you said, a discount versus a tracker versus a fixed, everyone was usually advising a 2-year fix because they keep trying to churn the rate. That doesn't happen anymore. We're looking more at product transfer. It's about retaining that business because it's cheaper to keep the business in-house than it is to go and search for new. And that has a knock on as well, Steve, to the broker, because their broker fees aren't as high.
Well, the remortgage market is the strongest market in the UK at the moment. So what we're seeing is that the business that originated through COVID is now flowing into today's remortgage market. So the purchase markets are more subdued, first-time buyer and purchase. There's definitely lower levels of activity there. So it's a great point, Nick. If you're a broker and you don't have a strong backbook of remortgage customers, then you're probably going to struggle if you're farming the purchase and first-time buyer markets at the moment. That being said, we've seen a reduction in product transfer transactions. So customers are quite prepared now even for a few pounds, to move lender because costs are being driven. So it's really front and centre for customers. I think in days gone by, saving £20-30 a month, you might just have opted for a product transfer to stay with your current lender. Whereas now customers will move for that kind of saving. So yeah, I would say that the remortgage market is definitely where most of the activity is, and right now in the UK.
I mean, you're talking a little bit around getting customers to stick and gaining that competitive advantage. Obviously, the market's really challenging just now. There's increased consumer demands. There's more competition with diversification of lenders. There's a lot of new market entrants around fintech, that sort of stuff. So how I just want to understand how lenders can gain competitive advantage in the market, with the market the way that it is just now, and sort of what role technology and data can play in that as well.
Should I jump from the tech side and then, Stephen, you can relate it probably more closely to you as a business?
You lead the way, Nick.
Yeah, well, let's see. So I think what we've seen, and my experience is having worked for mortgage lenders in bank, that kind of thing, you see the tech stacks you're working on. As we said earlier, some of them are old, they're not used to it, you can't build a product as quickly. You might have to go back to the technology vendor to build that product and then push it in for you live because you don't have the capabilities in-house, or the system won't allow you. It depends on your restrictions. What we're seeing is a lot of, obviously Mambu, for those who don't know, was built around the new entrants. The bulk of new entrants chose Mambu. We've got over 250 customers globally, and they looked when the new entrants of banks launched into the SME sector and deposits. You bring your deposits in to fund your lending. However, we've transitioned. We're about 11 years old now, and we've, as a business, grown up and matured our product massively. We continue to do that. It doesn't just stop, which is actually seen as work with much more transformational business. And we've moved, certainly in the UK, and that's happening globally now, into the mortgage space, where you have got older tech from a cloud native core engine. Mambu's driving lots more features. We're never going to be that legacy tech stack that does it all in. We want to give you that kind of power, but we work in partnership with people like your MSO. We're currently working on a project where there will be an integration between MSO and Mambu. We've got other integrations happening as well with other providers out there who do mortgage originations as well. You've got your likes of Encino out there. You've got your Mars. There's lots of people doing new things in tech, which means you can speed up the application process, which gives you a better user experience as a broker, also as well as a consumer from the direct to consumer side. So we see a lot of innovation. The smaller challenger banks are probably embracing it more because they can. They've got less legacy tech stack that they have to cater for. You've got probably a smaller customer base, so you can do it. You can have more fun with it, essentially. And you look, I know Atom Bank are one of the ones who came out to use open banking as a challenger quite quickly. We know the CMA9 had to do it and offer up the data, but people are embracing it now, which means you talked earlier about those paper bank statements. They don't need to. They can get all the data they need through open banking, and that's really good. And I think the lenders themselves are embracing it, but a broker can't because it's too expensive. There are still hurdles. We need to make the technology and the data more accessible to everyone, because I'm sure, Stephen, you would think if a broker can do it, brilliant. It's less onus on me, but they can do some of these checks for me.
Yeah, I think for me, the starting point on sort of competitive advantages around your purpose as a business. So what is your purpose? Do you want to be fastest? Do you want to be the cheapest? Do you want to have the best UX, easiest to use? Or do you want to be the most flexible? It depends on which one of these you're picking as a lender. If you want to be the fastest, then as Nick rightly says, you need to look at that tech stack. So a lot of smaller lenders don't have any ability to ingest third-party data. They can't hook up with an API interface to, open banking, or to take wage slips direct from payroll providers, or So I think you've really got to sort of begin with the end in mind as a lender and decide, right, what is it actually we're striving for? For us, it's a personalised approach to underwriting and flexible service, but we use technology to support that. So what we want to do is make the user experience as easy as possible for our customers and for our brokers, and take the data to the underwriter to allow them to make the decision as quickly as possible, to come to the right decision as quickly as possible. So that's where we gain our competitive advantage. And there's a disparate landscape of technology across the building society sector. There's a lot of legacy systems that are actually really poor. They provide a really poor user experience. They don't give you that API connectivity. They really aren't fundamentally fit for purpose. I think what we're starting to see now, our building societies sit up, take notice. You should survey your customers, you should survey your brokers, you should listen to what they say, and you should act on the results of those surveys. And we're pretty fanatical about that, and that's why we are right now at the back end of an integration to bring MSO into our business, so that our staff, our customers, and our brokers can use it. And this stuff, you'll know, it's not cheap. It's expensive. It's a £1 million spend for us, but it's the right thing to do, to give everyone the best possible user experience.
And even coming from a tech stack, sorry, I was going to say,
No, go for it.
I come from the tech side, so we want people to buy technology. Brilliant. But from a mortgage perspective, everyone is an individual. You can't just assume technology is going to give you the answer. It won't. It's a combination of everything. We don't want to get into a world of computer says no. And again, there's more mortgage prisoners. We need that human element, but the human element shouldn't take 2 months because they've got a backlog of paperwork to look through. It should take 2 days because the technology's accelerated it for them. So there's a part to play for everything. It's just about getting that right balance. And we don't want to end up in a computer says no to everyone's mortgage applications, and then we just end up with, a specialist lender that will do it but hike the rate up, because then it's not good for the consumer at the end of the day.
Absolutely.
Yeah, definitely. I'm glad you both touched on the consumer side of it, because there's obviously different elements to competitive advantage. There's looking at the operational efficiencies, bringing more speed, more flexibility to how you can work internally. But I think it's really important, if you're looking at long-term competitive advantage and sustaining those relationships with customers, you need to think long-term about how we can improve that customer experience. So can we just touch upon just a little bit around sort of how we see technology impacting that at the customer side of it, in terms of the process and the stages that they go through in the application? I know, Stephen, we've talked about areas like digital identity and that type of stuff. So where does all that tie into this as well? And where do you see that in terms of importance in relation to that versus like the technology that sits on the lender side of it?
Yeah, so there's a piece of work going through just now with DSIT, the Department of Science, Innovation and Technology, to effectively have a uniform set of standards for ID verification that should sit in the government's digital wallet, if you like, and then that ID can be used throughout the mortgage supply chain. One of the biggest frustrations for customers at the moment is that they have to provide ID and address verification at multiple points within the mortgage process. So if you were buying from a builder, this is probably going to be one of the more extreme examples, but you would have to validate your ID and V to the builder, then to the broker, then to the lender, then to the solicitor. You imagine how frustrated the customer will be at the end of that process. So what we need to do as an industry is get better at just validating ID and V once. And if we can't do it once, if the standards that are there for the builder don't meet the standards for the lender, then only top up to the standard for the lender. Don't go back to the start and ask for every piece of identity verification again. And I think that's coming. There is a strong sense that we are going to get that right. There's a piece of legislation that seeks royal assent over the next few months that will fundamentally change the way that we validate ID and V. So I think that's something that Nick, you'll be, again, my knowledge is, I wouldn't say puddle deep on this, but I don't have a great depth of knowledge on this, but I'm quite passionate about tech, and I'm watching this from the sidelines enthusiastically. I think this maybe, we maybe are going to get this nailed down and get it sorted for home buyers and sellers this time round.
Yeah, I think from the Mambu side, obviously we're the B2B aspect, so a customer never knows really about Mambu, that we're a part of the puzzle, but the business certainly do, and that has a knock-on effect. So, if a product launch is taking too long, that could be because the core, which Mambu offers, is legacy and they can't move as quickly. So from our perspective, we're a facilitator in the business being able to get to market quicker, offer their customers a better experience. We all know what we expect, and I think it's quite interesting. I come from this background, but friends of mine don't. They might be plumbers or Sparkies, and for them, they take it as the norm, that is what you do. You go to a broker, or you give them the paperwork, or you always have a headache with your banking. But then when you use things like your Netflix or your Amazon, it's just a click of a button, it's there, it's done. Everyone's expecting that. And I think banking is, some of them are doing really, really well. Some of them are on that journey, which when you go into your bank and it's a brilliant experience on the app, it's really quick to pay. Others, they might still want you to get the old card reader out, and you're thinking, really? I want to send 20 quid to someone and you want me to put a card reader in, put some numbers in. You should have, it's your money. And I think some of them, you can see some of them on that journey. I was with an unnamed bank that still required the card reader. I left and I went to another bank that is much smoother to use, easier to use in the app. You talk with your feet essentially and just move, because they've got a better user experience. They will catch up, but you expect those with bigger pockets to offer that tech that the consumer can have the knock-on impact for.
Yeah. And the pieces of the puzzle are there, so if you want today as a lender to take wage slips direct from a payroll provider, there are two of the large credit reference agencies that now offer a solution that would allow you to do that. There are multiple vendors who would allow you to use open banking to validate bank statements and validate affordability, which is a key kind of plank of underwriting a mortgage. So the pieces of the puzzle are there. It's just about how we integrate them into the mortgage journey to improve it for customers. And as you rightly say, Nick, some lenders are probably getting that a bit better than others. There's some of the larger banks, again, we're not going to name any names, they're still working from physical servers. There's challenges out there, real challenges for some of the larger businesses with legacy infrastructure that they probably need to get right before they move on to these kind of third-party adaptions that will allow them to improve their mortgage journey.
Yeah. It's a difficult question, I think, for any lender or even savings provider, you name it. Any financial institution, it's a big decision. Where do you start? What's the budget on the project? As you said, Stephen, it's a big investment for Scottish Building Society. It's a big investment and a big risk for anyone to take on this challenge. The chief execs will be sitting there thinking, do I want to be the person at the helm for this change or this development? What do I do first? Do I just do the new front end? That's one piece of the puzzle. As we talk, there's so many technology providers out there, and I always use the term best for purpose, because there are different providers doing the same thing in a different way. I don't think anyone's a best of breed. What's right for the business is right for the consumer, and they will make that knock-on effect. But yeah, do you start with your front end? Do you start with your ID&V? Do you do your core, or do you do it big bang? There's lots of options. They all come with a cost, a time lag, and you have to operate BAU at the same time. You can't stop doing what you've got to do.
You can't. You're literally changing the tyres on the car as you barrel down the motorway at 70 miles an hour. And ultimately, the investment in the business is important, but it has an impact on your costs, which have an impact on your pricing model, which have an impact on how competitive you are as a lender. So there's quite a few moving parts. And then you look at the various so you've got the mortgage front end, you've got the originations aspect, core banking, you've got your decision and logic tools, and you've then got your third-party integrations. And all of them, there's a project that needs to sit behind that. There's a team. There's a cost. So you've really changes. I think the thing I've learned over the last few years, we've got a lot better at change. There's real art to it. And our head of change, Graham Lowe, talks a lot about what he calls the decision tree, if you like, or that decision line. So what stop are you going to take on this particular project? And actually having a really good coherent view of how not just the next 3 months, but the next 6 months, year, 2 years. There's only so much resource within the business, and it's when you actually, when you're going to choose to solve that that particular problem. There's more of a strain for a smaller business. We have around 100 full-time staff, so you find you can end up leaning on a lot of the same people to implement change within the within the business. But it is such an important part of what you do. And I just come back to, again, listen to your customers, and don't assume that you know what they think. I was talking to Ian before we came online, and we have Passbook for savings, and you would think Passbook was outmoded and customers wouldn't want it. Our customers want a Passbook. And some of the larger banks have been some of our best introducers over the last few months as they close Passbook accounts, and those customers come to us because they're fanatical about their Passbook. They like the idea of writing something down, having it in a drawer, And that comes back to the omni-channel. So that's one part of the puzzle. Yeah, Passbook is just part of it. You do have a digital app as well. You have telephony. You have in-branch. But if you don't listen to your customers and understand what they want, then fundamentally you could get that quite wrong.
It's a really interesting point. It's a really complicated stack across the entire process, from the infrastructure to all the different parts of the supply chain. I'm just wondering, where are we in terms of like a joined up approach to all of this? Because Nick, you said there's decisions to be made within an organization around, which parts do you focus on? Is one part of the ecosystem focusing on certain priorities with others focused on others? And is that really leading to end and rapid benefits to the consumer, or does it need to be a bit more joined up? And I think that ties in a little bit to the data and the infrastructure around it as well. Because Stephen, you touched upon like open finance there slightly, and the impact that can have, and there's certainly potential within that. But again, it's just about getting everything joined up in the right way. So what are you sort of seeing happening in that space, and is there more that we need to do around that?
So for me, I quite like to see us. I would be a customer of yours, Nick. So I would quite like to see a technology stack that's well connected and everything talks to each other.
Yeah.
So there's nothing worse than looking at a stack where there's a lot of rekeying and manual work. If your front end talks to your core banking, talks nicely to your decision engine, integrates with your third party tools, that's quite a good place to be. Whereas if nothing talks and you're having to use synthetic APIs and rekeying and all this kind of stuff, and robotics or field order technology, what you're doing is you're just creating a lot of redundancy within the process, which is a drag on staff, which creates a poorer process for the customer. So actually, it's a great question, and I think a high degree of connectivity across your stack is actually probably quite a good place to start. And sort of assume that a lot of lenders will have that, but actually that's not the case. There's still a lot of manual keying, and there's a lot of the larger software vendors who don't want to play ball. They don't want to integrate. They don't want to work with others. They're closing ranks. They don't, they feel threatened in many ways. I think is what I'm trying to say. I suppose it's an industry built on trust, and you've got to have that trust that we can work together to build that high degree of connectivity to benefit the end customer.
Yeah, I think for us, we have 170 partnerships globally. They are worked via, APIs integrations. Mambu is an open, modern core tech stack, so that's how we operate. As you say, when it comes to things talking to each other, it's expected, but it's difficult. You move one piece of the puzzle out to put something new in. It doesn't mean that it's going to make everything connect, because everything has a knock-on effect, and then you have to keep moving kind of the feast, essentially. What do we do next? How do we move it? So yeah, we certainly see lots of partnerships with providers, from originations for your payments to your KYCs, which is to be expected. And the consumer feels it, but the staff feel it as well. As you said, if they've got to rekey it, ultimately all of this comes back to when we look at a project and we're working with someone who wants to transform their business. A lot of that may have been 2-3 years in the making. The base rate increase has probably actually given them more money to fund the transformation, because mortgages weren't making money for a long time for these lenders. They just weren't. And you'll know this even more than we will, Stephen. As much as everyone thought they were making money, they weren't. When you're dealing with a 1.5% fixed fee, they're not making money. Since the base rate's gone up, it gives them money to put into transformation to give a better customer experience. And that's where these new partnership players come in. From us, yeah, you're right. There's some people don't want to be open and want to play. You don't probably want the tech stack all under one roof, because then you become a jack of all trades and a master of none. And if you want resource and someone says, I want to improve this because my customers are giving me feedback, where do they start? Do they go on the core? Do they go on the front end? You talked about your passbook. You're right. Lots of people still want that passbook, but that's an element that will integrate to the whole solution. You'll need a physical printer for that passbook. That will have software that will connect to something else, that will connect to the teller system, because they're going to have to connect to all of that. So it's a continual knock-on effect. Not only the consumer feels the benefit, but those staff members. I think what we see is a cultural change within the banks, and you'll probably have this, Stephen, on your side as you're doing this MSO project. It's actually a cultural shift in your business, that you are going to something different. That means the person who's been with you for maybe 10 years doesn't have to rekey it, and they're probably chomping at the bit not to have to rekey an application. It's going to be an integration.
Absolutely. So leave behind the most dangerous expression in any business is we've always done it that way. It's like leave that behind. And that particular platform, the MSO platform, is a platform again based on trust. That everyone does their bit within each component part of the process, and then you can hand it on to the next person to move the mortgage forward. And that's actually not necessarily how some of the legacy technology has worked. So there is fundamentally a bit of a leap of faith when you bring a piece of technology into your business which works in a very different way, but you just have to trust the tech. You also need to trust the feedback from the markets. We are quite fanatical about surveying. Again, I come back to this. We look at smart money people and the feedback from their surveys, which encompasses, it's pretty much every mortgage lender in the UK, and you get fantastic feedback from mortgage brokers. Read those surveys forensically because they'll give you some really good tips on how to, what technology you should be bringing into your business. I think that's so important.
Good stuff. So you talked there about sort of leaving the legacy behind and taking that leap of faith. So it leads us in quite nicely. Sort of if we put our future gears and goggles on and look, 5-10 years into the future, what do we see that sort of mortgage technology looking like? How do we see things evolving over that sort of next 5 to 10 year periods? And what do the future of mortgages look like?
I mean, I've got a view from a tech side, but I'm sure from the finance side it'll be different. I mean, the tech stacks are moving on. Technology is advancing, and you can see that everyone's starting to make they're not giant leaps anymore. I think we can be honest. They're not giant. Everyone's coming up to a level. It will be like when we talk about your iPhone. New iPhone comes out, it's a slight tweak. It's not changed the game. I think what will happen is there's a lot of lenders and financial institutions that are still behind. Only some of them are at the front with their technology stacks. As you, Stephen, you're on a project. More people are going to start the project over the next 2 to 3 years, I think. There'll be more transformation. People will start to accelerate and deliver for the consumer. We will then see maybe not a consolidation, such a slowdown in new tech vendors coming to market in this space, because if you've implemented, you don't put someone in for 12 months and rip them out again, because as we said earlier, the cost of it, the change in demand on the business, you can't do it. When you do it, you need to get it right, and you need to choose the right partners. So I think you will see improvements in the technology providers that are here today, such as Mambu. We're going to continually evolve, add new features, add new functionality, make it more secure, faster, offer more resilience, that kind of thing. So you're going to see improvements in what we have today. Ultimately, the way I see it as being a consumer having a mortgage, we can do all we want. People like Scottish Building Society can do this great transformation. They can deliver for their consumers. But ultimately, we need to probably say, well, outside of mortgage technology, what's the biggest factor? Conveyancing. Until we get to that part where we're not waiting weeks or months for solicitors to go through an in-tray and do a search that takes 3 weeks for a piece of paper, that's a whole new sector and industry that we need to look at, because the mortgage world can only do so much, invest so much. We'll continue to see the change. You're going to see more transformation, but it needs to be that knock-on effect, bite size. We've done our bit, who's next? And how does that integrate? And how does that deliver for the consumer? Because we know, we've been there for a while, you can get the agreement in principle came in minutes, then the mortgage offer came in minutes. Brilliant, you've got your mortgage offer. But now I'm waiting. And when you talk about the speed of market and purchasing, getting gazumped to making sure the process goes smoothly, we need everyone else to do their bit as well. So I'd probably say from a very high level, not in the lender like Stephen is, we've got great tech stacks out there. We're going to continue evolving Mambu. Our competition around us will do the same, but we need everyone else and the other knock-on effects and our partners that are part of the process to do the same.
Yeah, the conveyancing one's really interesting. You thought more might have been done around like smart contracts and things like that in that space, but it's seems pretty stagnant still. It's something I actually looked at for a startup a good few years back, but it fell flat on its face.
They don't want to change it. They charge by the hour. Why would they?
Good luck to anyone that's wanting to take that challenge on. So, Stephen, what's your thoughts then?
So, I mean, there's some interesting things happening in the market at the moment, in the here and now. There's quite a lot of lender consolidation. So we've seen the Virgin Nationwide announcement last week, 2 weeks ago. I think there's obviously Kensington and Barclays merged the year before, or the announcement was made the year before. Coventry are looking at co-op. Whether that goes ahead or not, I'm not sure. So there is quite a bit of consolidation among lenders, driven possibly by strain on those larger lenders' models. Some of their models are under threat. So we could see consolidation. That's not good necessarily for the market. So there's a sort of tall redwood syndrome that we see, where the large incumbents block out small competitors. And we aren't really seeing small breakthrough competitors scaling businesses quickly. It's actually quite a difficult thing to scale a bank and grow it quickly. And Nick would tell you, sort of 7 savings accounts to fund a mortgage. So you've got to get both sides of the onboarding within the balance sheet right. You've got to have a compelling way of funding, which can be organically, or you can, fund through wholesale as well. And then you've got to have a competitive and compelling mortgage proposition and/or business if you're in the business and commercial sector. I don't necessarily think the consolidation that we're seeing just now is a good thing for the market. I think more lenders, more competition is better, and we're more likely to see advancements in tech coming about through that. I'd love a time machine to go 20 years forward and see what AI does with all this. It's inevitable that artificial intelligence will play a part in the industry moving forward. And I think we're likely to see things like potentially criteria sifting at the front end of the mortgage process being done by AI, which then begs the question, do you see disintermediation and people like me disappear from the market who are broker specialists? It's possible. Do we see AI underwriters? That is also possible. I mean, these language learning models the ChatGPT is just phenomenal. What it can do. And I think it's inevitable that's where the market will go. I watch risk-based pricing quite closely, and I feel that's something that you could see shaping the market, not in the here and now, but maybe 10 years in the future. So if you were to create customer segments and cohorts and categorize customers, so for example, Nick's an A1, I'm a B2 as an example, and you then have a price model that fits the individual, it takes a lot of the pain out of the process. There is no need to underwrite at that point. You can rely on third-party data. You could rely on my social media usage to underwrite me potentially, which some lenders have looked at. Apparently your social media usage nods to your credit worthiness and what's on there. So, there's a lot that could happen in the next 10 or 15 years. But I think to start off with, I think Nick's spot on. I think we'll see small, slow, incremental change. And then, tech will start to, I think, really stretch its legs. We'll see a bit of momentum. And then as soon as you see the larger players, LBG, HSBC and the others starting to embrace this kind of technology, you'll then start to see, a fundamental shift across the market.
And that's the way they make the shift as well, isn't it? It's a question of, do they buy, like we're seeing now? We're seeing consolidation. Do they buy a provider who's got a great mortgage book and maybe they're buying it for a tech stack because it's a cheaper option, they can send their business that way? Or do they put a speedboat on the side of desk and start building something without the migration risk and run the other book down? There's a lot of options that people need to consider, but sometimes the machine is moving so quickly and it's going to be such a difficult project that it just gets pushed and pushed and pushed. But I think AI is an interesting one, and certainly on the mortgage side, because you never want to lose, as you said, Ian. If you had AI, would anyone have noticed that you were in that mortgage prisoner type of thing, or would it just be like, no, he sits there, that's what he gets?
Absolutely.
So certainly interesting times.
It's only as good as the data that sits behind it. I think it's like I'm intrigued to see what happens with the amalgamation of open finance data and then the AI piece. But there's obviously a lot of risks that are associated with that as well. And it's how we obviously need that human element on the decision making. I think always to look at someone's circumstances, and the data can only tell so much of a story. And if we're doing things like looking at social media usage and things like that to make decisions on mortgages, then that's quite frightening to me. So
it's absolutely terrifying. I think
get the data right, and make sure we're getting the data from the right places to make those decisions. So there's definitely a lot of potential there with it, but a lot of risks as well, just to be aware of. But I think that's just generally the chat that you hear across the board with AI now anyway, isn't it? So it's not just something that's unique to mortgages.
I think every event you see is talking about AI now. It's the hot topic that everyone's going after. It's still quite early for it. I think we've got enough to address. We can see that everyone wants to know that I suppose the technology stacks they're moving to can set them up for future success, where AI can be considered. Where they are today, you couldn't even consider it. It wouldn't be a consideration.
So for most lenders, it's a relevance piece. You want to remain relevant in the current market, and you want to make sure that your business and your brand can remain relevant for the next decade. Most corporate plans will run a five-year plan that you set out to your board, and lenders tend not to think much beyond that 5-year horizon. So yeah, I think you're spot on. It's unlikely that anything like AI will have an impact in the short term, or certainly over the next 5 years.
Thanks. Well, I think we can sort of come to a close there now. I think overall pretty upbeat feel about the market from where sort of UK finance were at the start of the year, and the bleak outlook that was forecast. I think things seem to be moving in a positive direction, and certainly on the technology front, things seem pretty exciting and to be moving in a positive direction. We can tie things up there for today. Just for any listeners that do want to continue the conversation or loop in more around mortgages, we do have a mortgages hub going live on FinTech-Tables, so you can go over there. There'll be more content, more articles featuring Steve and Nick and various other contributors from the industry. So yeah, if you're a lender or even a borrower and you want to find out more about what's happening in the space, please do jump onto the hub and check out what we're doing there. All right, so that just leaves us to thank you both, gents. So thanks for coming on the show today. It's been a pleasure. And
thanks, Ian.
I look forward to catching up again soon.
Thanks for having us.